Gagan and Jagan, well, they are both childhood friends and share a long experience of investing in the primary market, that is the IPO market. In the last 2 years, both of them have applied for IPOs of all companies, investing 2 lakh rupees each time. They have successfully subscribed to almost all the companies. Despite investing the same amount and putting money in similar companies, there is a significant difference in the returns for both. Gagan is experiencing substantial profits, while Jagan is only making modest gains. Out of nearly 100 IPOs in the past 2 years, almost 20 IPOs are trading below their issue price. So, why is there a huge difference between their returns? Let's find out. Now, to understand this, we need to look at their exit strategy from IPOs. First, let's understand the difference in Gagan's and Jagan's portfolios. Jagan still holds shares from startup companies such as Paytm, PB Fintech and Delivery even after 1.5 years to 2 years of listing. These 3 shares are still trading below their issue prices. The fact is, the offer documents of startup companies are often very promising, but in the first 2 quarters, the entire picture changes when losses persist. Not only that, Jagan also holds shares of LIC, which listed in May 2022 but has never crossed the issue price of 949 rupees. This is despite the fact that the market was eagerly awaiting this IPO. Talking about Gagan, he's holding shares of Zomato. It had a bumper listing compared to the issue price of 76 rupees, and this share was listed on the NSE at 116 rupees in July 2021. In November 2021, the share even touched a high of 169 rupees. However, currently, the share is trading at 122 rupees. In addition, he also holds shares of Plaza Wires, which has delivered returns of more than 2 times within a month of its strong listing, and Keynes Technology, which has earned more than 4 times the investment in less than a year since its listing. Now, the shares in Jagan's portfolio, well, they are all in losses, but the shares held by Gagan are performing well. So, how do we decide which shares to exit after listing again? Well, according to Arun Mantri, the founder of Mantri Finmart, there are no set parameters. However, if an IPO enters the market at a high market PE, indicating a valuation above market expectations, it tends to experience a reversal within 7 to 10 days. In other words, there is a profit booking in the shares. On the other hand, if the valuation is good, listing gains can be sustained for 1 to 1.5 months. We also need to assess the sector in which company operates. If the company is in a growth-oriented sector like renewable energy, the stock tends to perform well. However, if there is high competition in the sector and the likelihood of growth is low, the share may face challenges. In contrast to Jagan, most of the shares in Gagan's portfolio are still profitable today. So, how do we decide which IPOs to hold for in the long term? Well, according to market expert Ravi Singh, decide before investing in any company's IPO whether you're investing for listing gains or for the long term. For long-term investment, one should invest in a company with good fundamentals, pending orders, consistent profit growth in the recent quarters, and cash on the balance sheet. Ravi Singh also believes that the best strategy for investing in an IPO is to never fully exit the entire listing gain. Only withdraw the initial capital and continue to invest in shares equivalent to the profit. If you are getting 50% gain, then withdraw 50% of the capital, and if the gain is above 100%, then withdraw 100% of the initial capital. Then consult a financial advisor about when to enter again. On the other hand, Arun Mantri believes that when considering holding a company's IPO for the long term, it is crucial to look at the brand. For instance, with the upcoming IPO of Tata Technologies, a good management, potential for profit growth, no company debt, and a situation where the company is not incurring losses can make a high valuation stock sustainable for the long term. Now, such a share can be held for an extended period. So, when investing in an IPO, each investor should have a unique strategy rather than a one-size-fits-all approach. If the brand is strong and the company is part of a growing sector, it can be held for the long term. However, this is contingent on the company making profits and being debt-free. But if the valuations are not reasonable, it may be wise to take the money and exit after listing gains.